Welcome to the daily update, where I'll go over the action in the market for Wednesday, October 23rd. Then we'll see how things look for Thursday, October 24th. Well, it looked like buy the dip didn't really happen in Wednesday's session. We had a lower open, we just kept going down. We tried to plateau a couple of times. Some buying came in, but it didn't last very long, and then we just kind of took a step down to the next level lower until we got to the S3 level for Wednesday's session, which usually is not calculated on the chart. I have to use my own pivot point calculator to bring that out. We hit that level. That's also going to be S2, I believe, for Thursday's session. It's either S1 or S2, but an important pivot level. So you can kind of see the mathematical things coming together. We'll have to see if these support levels hold. Now, for right now, we're still positive because we did drop down below the 20-period moving average, but we came back up and were able to close above that. But we're a little bit below 5,800, so we did lose that level, and that's probably what the financial media is talking about because they like round numbers like that. So we are seeing some weakness coming in. We pretty much have worked off any kind of extreme readings in the short and intermediate term. We already have one extreme negative reading in the short term with the Stochc RSI. So we're seeing this weakness. This is also a seasonally weak time, at least for this week. Now, we didn't go through seasonal patterns back in September that usually happen. We just went sideways to even setting new all-time highs. But this is still the week after options expiration, which tends to be down more than up. And during an election year, we do see weak seasonality, and that's what's playing out, at least to this point. We'll look at the seasonal charts here and see. As I just started to record, the futures are up about 0.25%. So we'll have to see, are we going to see more selling into that? Now, the last couple of days, especially before Monday and Tuesday, and even Wednesday to a degree, the futures were pretty much flat, but then they started to go negative after Europe opened. And that's when things were taken down a little bit. In Monday and Tuesday session, that was seen as a buy the dip type of a thing. And then prices bounced up from there and actually maintained more of a positive stance, even though we had slight down days. But on Wednesday, we seem to see a shift where things are looking a little more negative. But we are still positive overall. So we can bounce up out of this and take it as just a short-term pullback if we see some strength from here. But we also want to be on guard because we're seeing some weakness starting to come in that could take things even more negative. Before I get into the charts and more analysis of what's going on, there's a thing called the SPXInvesting Program. It's a program I developed. It's up, it's going, it's free until the end of 2024. If you want to gain access to that, there's a link below this video that will take you to the website, also a link to a video. If you have any questions, you're more than welcome to email me. One benefit is that you do get the videos right as they are posted. They're designed that way. They're meant to be viewed before the market opens, or at least near the open of the day, because they apply to that particular day. Also, the daily video is really where I focus everything. All the other videos around the outside, they're meant to supplement the daily video. Okay, so right at the open, we had a lower open and prices dropped below S1 at 58.27. Then instead of bouncing back up, which is what we saw on Monday and Tuesday session, at least maybe a little later in the day, this time we continued to drop. We got down below S2 at 58.03, so now we're dealing with that 5,800 level. We did set the intraday low slightly above S3, which I'll show you on the intraday chart, at 57.61. And then prices rose to close below S2 and slightly below 5,800. But we saw some buying coming back in. That could be taken as positive. We were down 0.92%. And one thing that's also positive here in this context, we had a down day and we're still below average with volume. Now, it picked up from Monday and Tuesday session, but still below the moving average that I usually show. So we're still positive in the short, intermediate, and long term, but we're seeing some weakness. And don't be surprised if the market starts to throw doubt into this. Oh, well, it's just going to go up. It's an election year. Everything's wonderful. The economy's doing fine. The market likes to create doubt. That's why I look at so many different charts. You just can't get that insight by looking at two or three things and coming up with a 4 or 5 minute explanation as to what's happening. It may seem like the logical thing to do when we're really going up or we're really going down, but to see these subtle changes, that's why we have to do this analysis. And we want to keep an eye on the geopolitical things, not really impacting the market, not really impacting oil. There's a lot going on, specifically between Israel and Hezbollah and Hamas, and which ultimately leads over to Iran. But we'll have to see if things escalate to the point where it does impact the market. Okay, so rising interest rates. We have been seeing the 10-year yield going up, and then stocks were going up too. It's like, we don't care. Everything is just fine. Well, in Wednesday's session, that seemed to matter. And so that did put pressure on stocks. At least that's what the market is blaming for seeing more selling. And we're also seeing some real, very short-term strength in the US dollar. And both of those together, the market wants interest rates to at least maybe stay where they're at, if not decline. And they like a weaker dollar. Well, the opposite of that has been what's happening lately. And it's like in Wednesday's session, they suddenly woke up and said, oh, maybe we better react negatively to this by selling. The VIX is going back up. We're above 19. Now, the VIX signals that we've been watching, they're gone now. I'll show you the charts, but we're not looking extreme with these signals that I've been pointing out for, my gosh, a week and a half maybe. And it was like the market was anticipating some kind of a big move. Now, does that mean that the big move is over? That Wednesday was the big move down and maybe we'll be able to bounce up from here? That's just one thing to consider. But at the same time, we are seeing some more weakness coming in. We want to keep an eye on what's happening in the Middle East. Oil's just not really, it was down a little bit in Wednesday's session to around the $70 level. And we just have the stochastics. Now, these are a little bit longer term. They're oscillators, so they take a little, the way they're designed, they take a little bit longer to actually roll over. So we're still looking extreme with some of those, and I'll show you that chart. We already have the Stoch RSI that's extreme negative, a very touchy indicator, and it's gone extreme negative already. Intermediate term, we have the bullish percent index, but it's coming down. And this is the BPI for the S&P 500. All three of them that we follow are going down, but this one's giving us an extreme reading right now. And the context is that it's coming down from those high levels. So even though it's positive, the context is that it's looking more negative to this point. And then the 10-day new highs, new lows for the S&P coming down, but still extreme positive. Then in the long term, we're still holding up there because we're still dealing with the 20-period moving average. We're well above the 150 and 200-day moving averages in the long term. No real change to the scenario that we've been playing out here. And Thursday might be rather telling. We're going to get some more economic reports, and we'll be watching jobless claims to see, are they going up? Are they going down? And then is that likely to come into the scenario that, okay, maybe the economy's too strong and the Fed won't be able to come in and cut rates? Or maybe we're still doing okay and it's all right to buy and the Fed will continue to cut rates. And the dollar was up and interest rates were up. We're at 4.24%. We actually got above that 4.25 level, which is kind of a round number. And this is typically, oh, I think the range of the 10 years is going to be 3.75 to 4.25. Well, a lot of people say that, and we get above 4.25, and they're like, oh my gosh, we're above the high level here, and interest rates are still going up. We better sell, sell, sell. But we're still continuing to climb here. We had been at 4.2% with the 10-year yield. We closed on Wednesday at 4.24%. We're still inverted with the 10 to the 3-month, and the 10 to the 2 is uninverted or gone back to normal. We're ticking down. Now, the context of sentiment is that we're falling. We were at 75. Now we're ticking down. We were at 70. Now we're at 63. So the context is turning a little bit more negative, even though it's still positive if you just look at the number by itself. And this is another change that we're seeing. The ADX is now weakening. It dropped below its moving average. The green line's coming down. The red line's going up. They have not crossed yet. So we're still positive that way. But we're below the moving average, but we're still above 20. So we're still in a trending environment, but it suggests a weakening trend. And with the down day, our bias is negative. And I've changed the momentum over the last 2, 3, 4, 5, 6 days. I had been positive because even with Monday and Tuesday's decline, things still looked pretty good. Wednesday, that seemed to take on a little bit of a different twist. And so we're more mixed to negative now as far as the momentum for the market. So the economic reports, we had existing home sales. This was probably the biggest report of the day. They were down 1% month over month. When you annualize that, it's 3.84 million, less than the 3.9 million they had expected, and also down from the 3.88 million that we saw last time. If you look at this on a year over year basis, sales are down 3.5%. Mortgage applications, because interest rates are going up, down again, down 6.7% week over week. Refinance applications were down 8%. Purchase applications were down 5%. All right, here is the chart of the mortgage applications, where you can kind of notice as interest rates were starting to go back up, we started to see folks not getting new mortgages or doing much refinancing. It's less than what we saw the week before, but still declining. And here's the existing home sales, which are still positive here, but we're going down overall. I guess this wouldn't be positive. This is just a number. You can see in February of 2024, that's when they hit the high, and then boom, we're just kind of trailing lower overall. Even though the market still may be kind of tight for real estate, we're seeing this dropping off, and that could mean that some of the inventory of existing homes is starting to build up. And I show this chart. It seems like it crops up on Isabel Net every couple of days. This comes out from Real Investment Advice, and this is the ultimate driver of stocks. This is earnings. Now, this is an annual chart. This is the annual change on a year-over-year basis. And when when the blue area here, which is represented by a histogram, when it's going up, and this is looking forward. This isn't past or trailing 12 months that we usually look at. It's coming down just a little bit, but we're still positive right here. And that's what ultimately drives things in the very long term. Then looking at the annualized 10-year total returns forecast, they're comparing 2012 to 2020 and then 2024. I don't know if you get something out of this or not. Just what are you looking at? Where here the forecast is that we get a high of 7%. The baseline, which means we pretty much average more or less, it would be up 3%, and the low would be down 1% here. Then we're seeing a little bit of a disconnect here. This is the truck tonnage index, and as the S&P has been going up, that's the purple line, and then we see the yellow line here. It's actually going sideways to starting to decline. You can see earlier on, going back to 2002 or so, there's a real strong correlation between the two. Now they're on different scales, but usually these tend to move more hand in hand with what's happening in the market. So we're seeing a bit of a disconnect right now. 10-year Treasury yields, we watch these very closely. Of course, we're at 4.24% right now, so this chart's already out of date. The futures markets are anticipating that we're going up, where Goldman Sachs, they're coming out and saying, okay, we think it's going to go down to 3.85%. Interesting. And then U.S. equity market concentration from 1925 up to 2024. This is market cap of the largest stock relative, okay, 75 percentile. This is just showing U.S. stocks are still mostly dominating here and looking pretty solid according to this. And then bond fund flows by maturity in the last 4 weeks. So this is just telling that we're seeing some money coming back into bonds, but a lot less than in the long-term bonds and in the intermediate term bonds. It's more the short end that's not seeing as much inflows right now. Global money supply. Now, we used to have a thing called G3. Now I'm sorry, M3. And about 2004, 2005, they did away with that. And it's like, okay, these people are getting too much information from this. We better just like stop doing that. So now the biggest measurement of the money supply is M2. Well, they not only do that for the US, they also do it on a global scale. And this is looking at global M2 in US dollars. When you take US, China, Europe, and Japan, and the UK together, we can see that there's an increase that's going on here. And this is the US as well on the global, I'm sorry, in US dollars, where we're also looking at the year over year change. So that means this could be inflationary because that means they're pumping more money into the system, not only in the US, but also globally. This is what we also want to keep an eye on, the economic surprise index. It's starting to go positive, starting to go up. The more this goes up, that means that economic reports are coming in stronger than expected. And that could start to spook the markets. That could make them think, well, maybe the Fed's not going to cut rates after all. Maybe they're going to actually have to come in and raise rates or leave rates where they're at for longer than what they thought. So we want to see kind of a little balance here, not getting too far above zero, but not getting too below, because then that means the economy is really weak. Maybe Thursday's session will help shed some light on that. And this is kind of just for informational purposes. These are annualized S&P 500 performance by president. And in most recent history here, we've had Obama from 2009 to 2017. The annualized performance was 15%. Under Trump, it's 16%. And when they calculated this under Biden, it's 14%. And you've got Democrat, Republican, Democrat. There's bad times when we've seen it under a Republican president like Hoover. I mean, how'd you like to go through the 1929 crash? But we see good times, bad times, no matter who is president. It doesn't necessarily depend on which party has the presidency at any given time. And this is kind of interesting. We're kind of talking about that same thing. I got this from the front page of the Wall Street Journal, not their publication, but on their website. And it just looked kind of interesting. Wall Street pros get into position to profit from a Trump win. Now, it doesn't mean that this is automatic, because in 2016, right before the election, you could have easily swapped out the name Trump for Clinton, and that's what the market was poised for. They were getting in position for a Clinton win. And then when everything surprised everyone and Trump ended up winning, I go through that in some videos in the course that I teach, where it was like watching the Super Bowl or the World Series or something. It was incredible. But all of this happened while the market was closed. It was in the after hours market and in the pre-market. By the time we closed from one day to the next, there was a little change. But all this stuff that went on during the night, it wasn't that they were freaking out because Clinton lost or that Trump won. It's that, okay, we have to adjust things because we thought Clinton was going to win and she didn't, and Trump won, so we just have to reposition our things here. But this is suggesting that at least the Wall Street pros are thinking that Trump is going to win. But these are Wall Street pros, which means they're wrong as much as they're right. So I just thought it was interesting to look at this. Okay, here's the intraday chart. We're back on Monday. We were lower and then came back up. Tuesday gapped lower, came back up. Wednesday gapped lower, tried to come back up. You can see there was some buying that came in as we dropped under S1 here. But instead of going back up, we actually turned and went back down. Then we tried it again here and then fell back down below S2. And we actually got just almost to S3. And so that's where the support was set up. And that's why I follow these pivot points pretty carefully. And we did bounce up off of that. Now, if you take this last action in the market where we bounced up off of support and we're seeing a lot of buying here, mostly green candles, that could be taken as positive. Maybe there's going to be some kind of a bounce up out of this that will continue. Just watch for that, because we don't know what's actually going to happen. We may end up gapping down again and wiping out this nice little up move. But if we do see a bounce from here, because we're coming up off of the 20-period moving average, that could bring in some buying and actually turn things back more positive. And here's the intraday chart. And we're up about 0.25%, as I said in the initial overnight session. But this is when the futures really, they were looking okay. See how they were down a little bit here, but then we got back almost to the unchanged level. And then as Europe was opening, this brought the US futures down, and then boom, this is where we saw things happen during the cash session, and then the recovery that we saw later in the day. And this is still holding up all right, but we would like to see it even more positive if you want the S&P to go up. The blue line really came down. Growth got hit hard, and value got hit, but not as hard. And I'll show you that here in just a moment. But we're not really seeing much of a disconnect here between the blue line and the red line. But it was a negative day when you look at the intraday chart. And we had been kind of focusing on this. It's like, okay, maybe we're looking okay here with the growth to value ratio for the S&P. And that was pretty much wiped out here. So we'll have to see if some more buying comes in. Now, one takeaway is the bounce that we saw late in the day on Wednesday. We're not really seeing that reflected much here in the growth to value ratio. So that might give it a little bit of suspect. And the day chart, look how much growth was down, 1.5%, where value was just kind of down at 0.11%. And it was down more with growth for the mid caps as well as the small caps. So our end of day charts not looking good here with the S&P growth to value ratio in a downtrend. Mid caps growth to value ratio also in a downtrend and declined. You could look at this a couple of different ways. We're still holding up, but we are declining, but we're not seeing much follow through, at least yet, with our end of day growth to value ratio for the S&P. So we need to see this turn and go back up to be more positive. If it continues to fall, that would turn more negative. And we were seeing some improvement here, both in Monday and Tuesday's session, the growth versus value ETF. We'd come all the way up to the top of the rainbow. Boom. Now we're back down into the middle of the rainbow here. And we did see a decline with discretionary to staples. It had been showing some improvement. Not so much that discretionary was doing good, although it was okay. It's that staples had been under some weakness, and that's what was causing some of this ratio to go up. Well, we saw that drop off, but this is still holding up okay for the time being. Large cap growth was down over 1.5%, but still above all the moving averages here. So our trend, we're crossing below the moving average. That suggests a weakening trend. The ADX is now turned down. The green line is on top, but see how it's coming down and the red line is going up? If we have another down day, we theoretically could see a negative cross here, and we could switch over into a negative trend. And we're seeing more of a pronounced move here with dropping below the moving average here with the ADX in the short term, with the green line coming down and the red line going up. And we're still below average with volume. Sentiment, we got the latest reading from Investors Intelligence coming in at 2.67, more neutral-ish. We only look at it when it gets above 3 or below 1. That's when we really pay attention. And we're going back up here with the VIX on the line chart as well as the bar chart. And when the VIX goes up, the VIX of the VIX also goes up, both with the line chart on the bottom and the bar chart here in the middle. But the momentum of the VIX continues to be down. But if we start to go back up, that will certainly change. The problem with this is the MACD and our momentum oscillators, they lag. So they're based on what's already happened. And we just kind of get an idea of, okay, what is the momentum here? Well, it still continues to be down, but if we start to go up, that will change pretty quick. And here's the historical area where we've been kind of following along this fairly well as far as seasonality. I don't have an updated version of this chart, at least yet, but we've been up into the 19, and we were above 20 there for a while as we've been working our way through October. And this will probably go away if it stays below this dashed line now. For over a week, we were up over the dash line. When we look at the VIX to S&P 500 correlation, it's now dropped below the dash line. So unless we go back up here, I'll just kind of have this chart go away until the next time it starts flashing a signal. And the same thing is true here with the skew index dropping out of the red area. So you wonder, does that mean that the big move the market was expecting, is it now finished? Or is there still more to come? And we really went up here with this fear gauge, and we ticked up just a little bit with this other fear gauge. So seeing a little bit of confirmation there. Volatility risk premium actually came down, but we're still getting a very high reading. So there's risk that the market has determined when you look at this chart. And we just ticked down a little bit here with the daily chart of the equity put call ratio. So we're actually going back up with the 5-day and barely turning up with the 10-day. But this is very choppy. When both of these charts become more useful, it's when they're clearly going in one direction or the other. And we're just not seeing that right now. See, chop, chop, chop here. Advanced decline line, yeah, took a hit. coming down based on price and volume, but still above the advancing moving average. So that's holding up for right now. And we did see more new highs than new lows. We're still kind of pegged near the top with our 5-day, but we're going down now with our 10-day average. So this internal measure still looking solid overall, but in the shorter term, it seems to be working off some of these new highs that have been generated. And we're still barely positive here with the blue line. That's the short-term advanced decline ratio. It's declining, but still barely positive. And the red line is also coming down. That's based on 39 periods. Accumulation distribution rolling over a bit, but still above an advancing moving average. The boom indicator is really coming down as well. Now, this is interesting. The Chaikin money flow was actually up a little bit when you compare it to Tuesday's session, but not enough to turn the red line up. So this is still declining, but to have a down day like we saw, and we see this actually going up, are we going to be able to bounce off that 20-day moving average and keep going up with the late day bit of a bounce that we saw in Wednesday's session? And we're actually, well, kind of flat right here, but we had been turning back up slightly with the Chaikin oscillator, but it's still positive since it's above zero. Coming down, but we're still positive with the vortex. The green line's going down, the red line's coming up. And we did see the cumulative advanced decline line for the S&P based on price, where we saw a decline, seeing a decline also based on volume. Not really seeing, they seem to be performing about the same right now. And both are going down here when we look at the S&P and compare it to the NYSE advanced decline line. Coming down to the moving average with the cumulative advanced decline line for the NYSE, rolling over but still above an advancing moving average with the regular NYSE advanced decline line, and we're seeing that same thing here. The reason why I show two of these is if you zoom in on this, there's different symbols, and they're calculated in a slightly different manner. So that's why I look at two of these, just to see if we get any insight. But right now, they seem to be confirming each other. And then the common stock on the NYSE coming down here and declining, but maybe not as much based on volume. And we are seeing some weakness here with the advanced decline line studies, but we're still above the moving average with the NYSE common stock, the S&P, the mid caps, small caps coming back down to their moving average. After that nice little thrust up we saw, they've been under pressure pretty much since. And we're just barely positive here with the stocks inside the S&P above their 20-period moving averages, just a little bit above 50, where we're declining but still positive with those stocks above their 50-day moving average, still positive but declining with those stocks above their 100-day moving average and 200-day moving averages. Short term, maybe this little pivot point, we just were not able to get above that. And so far, we're treating that as overhead resistance. Now, this goes back a little bit because we watch these pivot points here. This is for the current month. These actually are from the previous month, but this still seems to have meant something along the way. And even though we picked up in volume, we're still below the moving average here. So we're declining with the 20, 50, and 200 period moving average study just on the S&P itself. Here's where we're extreme negative already with the Stochh RSI. Very touchy indicator. Williams percent R coming down, no longer extreme positive, still above the midpoint, but declining now. CCI 14 dropping slightly below the midpoint, and the CCI 20 is slightly above the midpoint, but all of these are declining. The force index has actually turned negative. We dropped below zero, and we're no longer extreme in the short-term stochastics. And I say that because this chart is a further subdivision of the short-term time frame. So we're not extreme in the short term, not extreme, but coming down in the intermediate short term, still extreme, but rolling over below the moving average with the long short term. And we're looking a little weaker here. The condition of the 20-period moving average, dropping below both the green line and the blue line, and now the lines are starting to roll over a bit. So the market's going to need to come back in pretty quick to keep this looking positive. If we continue to go down, these lines will roll over as well, and that might turn things more negative. 20-period moving average, we did drop below it, but we were able to get back and close above it. So for right now, this level is holding. And we're slightly above the midpoint with our standard deviations chart. So that's still hanging on and looking somewhat positive. Intermediate term, declining, but still above zero with the balance of power. Condition to the 50-period moving average, We did drop below and we closed a little bit below the red line and the blue line here, but they're still going up for right now. We're going to be watching that because if we lose the 20 period moving average, the next thing we're going to be watching is the 50 period moving average. The go no go, and they did some redrawing in here. I don't like systems that redraw in here. That's one reason I don't use Elliott Wave. It tells you exactly what you should have done now, but was telling you something completely different at that time when you would have actually been making a decision. And we kind of see that here with the go no go system, where now we're turning to the lighter shade of blue. The highest high, we're coming right about down to the midpoint here, still looking, just hanging on to a positive slant there. The TTM squeeze, which has been declining even when the S&P was going up, this still continues to fall and is turning more negative, but we're still above zero. And the ease of movement did decline, but we're still above zero here. The Arun declined, but we're still looking positive since we're above zero with the oscillator. And this is a concern. We actually saw this starting to develop with the S&P McClellan oscillator dropping below zero. It's continuing to drop now. So we're going down with the summation index based on price and volume. And we're also going down with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. And we turned negative here with the Swenlin trading oscillator. We were concerned about this. We declined both based on price and volume. Now we're dropping below zero. And price is going a little bit faster than volume here, but they're still turning negative. And momentum, which had been turning more positive, now that looks a little suspect. The PMO is starting to roll over. We crossed below the moving average based on price as well as volume. And so we're seeing some weakness here with the PMOs that are rising. The buy signals are going down, and we're no longer extreme. We've been up here for pretty much end of September, all of October. We dropped down now with the PMOs inside of the S&P that are above zero. We've gone from neutral to negative with the Elder's Impulse system for the S&P, but we're still positive here with the parabolic SAR. Now, if we have another down day on Thursday and we actually get below the low that was set on Wednesday, we could come back seeing a dot on top. So we'll have to see how this chart behaves. And this was looking more positive with the slope oscillator. Now it's turning back down and crossing below its moving average. In the short term, the MACD's already turned negative. And so we look at all of these. Now, you might ask, why are we turning negative quicker with the intermediate term than we are with the short term? That's because these move slower and it wasn't looking as good with the intermediate term as it was with the short term. And so when we start to go back and look more negative, they tend to move into the negative side of things quicker. But we're looking more negative here, where on the long term, the TRIX is still trying to be positive. The KST never really did turn positive, and it's right about on its moving average. And the moving average, the really dark or really light red line there, is declining. And the copy curve, which was turning positive, now rolling over, it's still positive. We haven't dropped back below the moving average at least yet. And we're no longer extreme positive with the Sean trend meter. It's declining as well. We declined here with the money flow, but still above 50. The ultimate oscillator is declining, but still above 50. We're declining, but still above the moving average with on-balance volume. Declining, but still above 50 with the RSI 14. That's more intermediate term. Just a tick or so above 50 here with the short-term RSI based on 9 periods. And we did come down below the 20-period moving average, but we were able to close up above that. So that's, at least right now, this is support that is holding. And now that we're coming down and we've seen a couple of down days with the bullish percent index, the context is changing a bit. We're still getting an extreme positive reading, but instead of going sideways or actually going up, now we're starting to come down again. And after getting a really high reading here with the NYSE bullish percent index also starting to come down, and we're still positive, but declining here with the NASDAQ 100 bullish percent index. And then here is the 20-period simple moving average of the open, high, low, close. This was an indicator I developed decades ago for a trading system that I used. I don't do that system anymore, but I kept this chart. This just sometimes can give us areas of support. You notice how we came right down to the purple line? That's the 20-period moving average of the close, and we were able to bounce up off of that. We're a little bit above these two middle lines here, So we're going to see if this ends up providing some kind of support. We're turning negative now with the hike in ASHI. We had more of a doji look yesterday. Well, this is turning black now and looking a little more negative. And we're turning negative with the Kigi chart. We've turned red and we're pointed down. But the Renko chart, it's like, what? Something happened? No, I'm still positive. And the three-line break is still looking positive. So we're seeing a mixed picture here with our different ways that we measure trend. Long term coming down, but still above the red line with the 150 and 200-day moving averages. And we're negative with the mid caps and the small caps now, but all the other indexes with the S&P and NASDAQ 100 are still positive on all different time frames. And bonds are negative in the short and intermediate term based on price, where we have commodities up in the short and intermediate term, and the dollar is now up in the short and intermediate term. And we only had two sectors that were up, and they tend to be more defensive. We had real estate up, which is strange because interest rates are going up. And we had utilities, which that usually is more defensive, but we're wondering if that's turning into a growth area because of all the green stuff. All of the other sectors ended up being down with discretionary and tech and communication. These are the three big growth areas here, and they were down the most. Lots of red. No Christmas here, just red. Valentine's Day. So we had a BPI cross below 70 with the materials, which is more economic in its nature. But we just have the NASDAQ crossing below 18.5, 18.4, 18.3, 18.2. It sounds like a countdown to a blast off. And then the S&P dropped below 5,800. And both are declining here with the S&P and then equal weighted version of the S&P. Not really seeing much of a disconnect there. The Dow, this is also another pivot point that we had been watching. The Dow just could not get above that. Now, it just set an all-time high last Friday, but it's really been coming down ever since then. And we've turned the negative with the diamonds, which is the ETF for the Dow. When we look at the Elders Impulse system, the NASDAQ was down 1.6%, but really hadn't been doing all that much. We were still going up overall. That could be in jeopardy now. We're still above the 50-day moving average, though. And the NASDAQ 100 also dropping over 1.5%, but still above its 50-day moving average. And we've gone from positive to negative with the QQQs because they were up slightly in Monday and Tuesday session. So this is the first real decline that we've seen so far this week. And now, where the momentum for the NASDAQ 100, we were turning more negative, and then we were on top of the moving average. Now we're starting to drop below the moving average. So that's looking more negative. And then we have the QQQs, which are the ETF for the NASDAQ 100. They did close below their 20-day moving average. So that support level is lost. You can see other times this was fairly critical, and we were able to bounce up off of that. Well, not at least to this point, this time, where it's still holding for the S&P 500. And then, yeah, we're looking really good here with small caps. And then, of course, they have to give most of that back quickly. We're right about at the 50-day moving average here. And we're still negative with the Elders Impulse system for the small caps. Then we look at the Russell 2000 small cap index, where we're dropping below 50 with the RSI. The 50-day moving average is still holding for the small caps. That could be positive, but now we're starting to turn negative with the momentum. And the mid caps also, after setting an all-time high and then dropping back down, but still above their 50-day moving average, they continue to be negative with the Elders Impulse system for the mid caps. The Wilshire, coming off of a recent all-time high, was down 0.89%, but still above its 50-day moving average. And the total U.S. stock ETF, also down 0.91%, but still above an advancing 50-day moving average. So this is where weakness may be starting to come in, but this area so far has been holding up. Staples to tech ratio chopping around quite a bit lately. We want this to go down to be more positive on tech. If this goes up like the trend is suggesting, that means staples are outperforming tech, and that would be more negative. But right after we saw this golden cross with the ratio, that's when we saw this ratio really coming down. Financial sector, after coming off of an all-time high, down again, but still well above an advancing 50-day moving average. The FANG index down 2.25%, and just not really breaking out since about the middle of July, but still above its 50-day moving average. So then I brought this up. This is the short-term trend. We were never able to get back up to that. and we're still above this longer term trend. We'll be watching to see if we see more weakness. Are we going to drop below that? But we dropped below this before, and then we were able to bounce up out of that. And you're going to look at the mega cap stocks here, the big magnificent seven or whatever, eight, whatever I show, and they're pretty much all down. Apple was down over 2%, but still above its 50-day moving average. Amazon down 2.63%, also still above its 50-day moving average. Google down 1.43%, still above its 50-day moving average. So these levels are holding for right now. This is the one we've been watching because Microsoft bounced off of its 200-day moving average, and it was in danger of giving us a death cross, and it was down 0.2%, but it's looking a little bit better here for right now. Meta was down over 3%, but still above its 50-day moving average. Tesla down underneath its 50-day moving average, down almost 2%. Nvidia was down 2.81%, but still well above its 50-day moving average. And Netflix, which came out with earnings last Friday that just blew everybody away, it was down another 1.96%, but still well above its 50-day moving average. Then looking at the US stocks and comparing them to world stocks, we're seeing more of a deterioration again in the short term and the long term with the correlation here. Oil just kind of hanging out around the 70 level currently. And even though we're in a downtrend with the dollar, we've just been screaming. We're up into the almost mid 104 range, where just at the end of September, beginning of October, we were dangling around the 100 level. That's a big move for the dollar. And we're just going up and up and up here with the 10-year yield. So we're going down, down, down with the 10-year based on price. And looking at the growth to value ratios, weakening below the moving average with Qs to S&P, discretionary to S&P after really looking solid there for a while. Now they're actually looking pretty weak. And we're coming back down to the moving average when we look at large cap growth versus large cap value. And with the large caps at the moving average dropping slightly below the moving average with the mid caps and the small caps. The S&P to utilities ratio, we want this to be going up. For the most part, it's been going down. That's more negative for the S&P. And just kind of chopping around, but overall have been declining with the Staples to S&P ratio, which would be positive for the S&P. It means it's outperforming. But we want to see this continue to drop with a little bit more conviction after it actually went up in Wednesday's session. So what's our outlook for Thursday? We're still positive for right now. And right now it looks like a pullback. We do have a confirmed Hindenburg Omen, and I stopped showing that chart until it updates, changes. And we have to ask the question, is weakness developing? We can't answer that question, at least in my opinion, until we actually close below the 20-day moving average. If we can bounce up off of that, if we can build off the strength that we saw late on Wednesday's session, yeah, this is just coming down to the 20-day moving average, testing that, and then bouncing back up. We won't know that until we actually see that happen. And then we already had some earnings coming out from Boeing, Tesla, UPS, and there's a whole slew of others that will also be reporting. And it seems like, from what I looked through, most of the earnings reports, even if they're stellar and really positive, they're seeing sell-offs anyway. We're going to get weekly jobless claims. This might be one of the bigger reports because it deals with the employment situation. And we're going to get another kind of big report. The global manufacturing and services PMIs will be coming out, the preliminary reading. New home sales will be coming out as well. And then just keeping an eye on all the crazy stuff going on in the world. And then what's developing or changing or shifting or staying the same with things with the presidential election and all the elections that are going on here in less than 2 weeks. Then on Friday, we're going to get durable goods and consumer sentiment. We'll see if those give the market some kind of direction. So here is what we look at for Thursday's session and then what will be coming out on Friday. Seasonality, we're actually neutral to positive with the Dow. We're flat out positive with the S&P, and we're neutral to positive with the NASDAQ, even though we're dealing with the week after options expiration. Now, this goes from 1980 to 2021 here. So we're just dealing with the recent past. Where we see a change in that is when you take all the election years together. This is the negative seasonality that it looks to this point anyway, like is playing out. And we still have some of that left, which will follow through into Friday's session. But we don't use this to make decisions. We just use this as kind of, okay, this is interesting. This is what has happened before. We'll see if something like that ends up happening again, and it would not be necessarily strange if it does. And Thursday is a pretty positive day when we compare it to 2023, and it's so far been the most positive day in 2024. Will that mean anything in Thursday's session? And then we're kind of coming down a little bit, but still seeing a lot of companies that are in their blackout period, so they can't come in and buy their own stock as they're reporting earnings. So the warning signs, we still have the Hindenburg Omen that's confirmed. We're watching staples, utilities, and healthcare, but notice how utilities, energy, well, not energy so much, but utilities were up. And the equity put call ratio, both based on 5 and 10 days, they are now back to going up, but they're not really screaming up yet. There's really a lot of choppiness right now. The Swenlin trading oscillator has now turned negative, and we have the McClellan oscillators for the S&P and NYSE. They're negative, and I have this in gold because that's a primary indicator, where the S&P McClellan oscillator is negative now, and it has been for a couple of days. Where we had been turning more positive with our momentum oscillators, now we're turning back more negative. We're keeping an eye on growth to value. The S&P growth to value, even though it declined, is holding up. We need to see that turn and go back up. Discretionary to staples also holding up for right now, even though it declined on Wednesday. And now the momentum for the NASDAQ 100 is dropping below its moving average. So that's turning negative there. Positive signs, still looking okay here with accumulation distribution. We actually went up a little bit here with the Chaikin money flow on a down day, but not enough to turn the red line back up. Chaikin oscillator going up slightly, if not sideways. So the smart money indicators are holding up for the time being. And we're still positive with the advanced decline line, even though we're weakening. We're getting back down to the moving average with the small caps. The Copic curve is still positive, but it is declining. Another down day, and that could actually drop below its moving average. We're extreme with the bullish percent index with the S&P, but now we're declining. So the context there is changing. We're also declining with the NASDAQ 100 and coming off of a really high reading with the NYSE bullish percent index. All of these are coming down now. And if we see more of that, that will just add more to this context of things turning more negative. If we can go back up, naturally that would turn things more positive. Parabolic SAR is still positive. The vortex is positive, but it's declining. And the money flow, ease of movement, and ultimate oscillator. These are secondary indicators that I follow. They continue to be positive, even though they're showing some weakness. The financial sector, down, but still looking solid overall. So our conclusion, we're just looking like a pullback to this point until we lose that 20 period moving average. That's what I'm calling this. If we drop below the 20 period, then I'll call it a decline. And then if we stay under declining 10% from the high, then that'll be a decline. If we go into that, then it's an actual correction. And we have to ask this question, is weakness developing? Yeah, we can see that right now, but where do we go from here? Is this weakness going to continue to develop? In the short term, it looks like we're just pulling back and the 20 period moving averages are holding at least to this point. Intermediate term, that's where we're asking more of the question, is weakness developing, even though we still remain positive and we're pulling back, but we're still positive in the long term, though. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.